Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And today I wanted to talk about a very interesting development we have on a breadth indicator known as the Advanced Decline Line. I think it's going to give some insight into what may be happening as we stretch into correction territory on the S&P 500. This is likely to be a familiar indicator to many of you. It's going to be new to others, so we're going to go at a pace that everybody can follow. But a lot to cover today. We're also going to be looking at existing positions and putting on a new trade. Before we can get to any of that, though, I first of all want to say hello to everybody chatting in out there on YouTube. Great to see you all again. We have Chris B. and Life in the Fast Lane, Kevin, David, Sharon, Will, Josh, Marcus, Joey, Doug, Paul, Austin, Greg, Mighty Mouse, everybody else. Thanks for joining us week after week. I really, really do appreciate your attendance and your contributions in these discussions each week. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, it's a Friday webcast series, and we kick this thing off promptly at 1 Eastern time. We'd love to have you here joining us in the live stream. But also here in the live stream, my very good friend Ben Watson is going to be hanging out in the chats. He's going to be helping us address any questions that I can't get to. As long as they're not too far afield, too far off topic, Ben's there to pick up my slack for me. Thanks for having my back there, Ben. And Ben and I would also like to issue an invitation to everybody within the sound of my voice. If you're not following your favorite presenters on X and you have an account with X, give us a follow. It's the best place to connect with your favorite presenters in between these live streams. So you can find Ben there at Ben Watson CS is his handle. Mine is at Cameron May CS. So let's get into this. And of course, as we start to talk about trading, we need to first of all talk about the risks of trading. These disclosures are important, so please bear them in mind. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including a loss of principal. Okay, so here's what we're going to be doing today. First thing that we're going to do is take a quick peek at our existing example trades in our paper money portfolio. We just have a couple. Then we're going to take a look at the S&P 500 through that trend value momentum lens that we use each week. See how things are holding up there from at least that technical perspective. Then we're going to get into this discussion of the advanced decline. What I want to talk about what it might imply to a trader, how it's built, and also there are a few variations of advanced decline, some that some traders just sort of stay away from. So we need to talk about that, and then we're going to plan and place a new example trade. So let's dive right into it. Let's go have a look at the Thinkorswim desktop trading software platform. And here we find ourselves looking at our two existing positions for our advanced charting webcast series. We have AbbVie, and we also have Amgen, which actually technically shouldn't be here any longer. I'll tell you why in just a moment. But starting off with AbbVie, let's bring up a chart. You'll see a little blue oval here indicating that was the date of entry. But let me come up to our study sets and load the study set that we used for planning this trade, which was just a quick ribbon study. And with this, we saw the RS1 line, our fastest ribbon, crossing above RS2, our next fastest, generating a relatively rapid signal. That was a primary reason for entry here, and we're waiting to see if that RS1 happens to dip back down below RS2. Right now, nope, price is cooperating. The faster is still advancing ahead of the slightly slower. So we're going to leave that one alone, let it continue to work. Moving on to Amgen, I think this is a little bit more interesting. This was last week's trade, and really this is going to be a demonstration of how some approaches to trading can have a trader in and out of a position pretty quickly, even faster than sometimes intended. So if we bring up Amgen, let me switch up our study set to the one that we used for the construction of that trade, which was a pairing of the gap momentum line with other technical observations on the chart. But what we noticed here was that the gap momentum line had crossed its signal line. It had gotten a little bit choppy. Let me zoom in here. It's going to spread out our chart a little bit, make it a little bit easier to read. But our gap momentum line crossed up above the signal line and then held above that for a few days. So here's our crossover. We were looking at it on the 4th day, which some traders use as a confirmation when things get a little bit choppy, because the gap momentum can pop up above, slip back down below, pop up above, and slip back down below, pop up above, and slip back down below in relatively rapid succession, creating kind of whipsaws. Well, guess what? We sort of had that again. So we took an entry here, and we actually saw a gap M exit signal. You can just see it's kind of off the top of the chart. Let me pull that down a little bit. There it is. Pretty much the day after entry. So the typical gap M exit would then be taken at the open of the following day. So you'll notice here my gap momentum exit at the open of this red candle. That might have conceptually been a slightly profitable exit. Still, pretty much a whipsaw event. This can happen when we get a sideways slope to that signal line. So for some traders, maybe they wait to get a little bit more severe uptrend to that before looking for re-entry. Anyway, so that trade, technically we should have been out of. However, I don't exit positions in between the webcasts because I like to be able to talk about them afterward. Now, sometimes a stop or a limit might be executed in between the webcast stream, but in that case, we'd go back and revisit it. With a gap M, there's not a way to necessarily anticipate when or if that gap MLX or that gap M exit might appear. So we couldn't, we couldn't place like, hey, sell this at $330. We don't know that that's when the signal ultimately was generated. Don't know that in advance. Oh yeah, Greg is saying, so AJ is asking about the ribbon study for each of these study sets. If you want to go back and see how these indicators are built, how trading systems might be built around them, make sure that you're subscribed to our Trader Talks channel on YouTube, first of all. So you can go down below the live stream right now, click on that subscribe button if you haven't done it already. You don't want to click on it again and unsubscribe. But yeah, if you haven't clicked it before, click on subscribe. It only takes a second, doesn't cost anything. But our Trader Talks channel is where we house our playlists of previous webcasts. The vast majority of the webcasts that we deliver live are then later added as archives to our playlists. And you can find all of our previous webcasts in this series. Just go to that playlist and then just zip right down here to the middle. There it is, Advanced Charting Techniques. Click on that View Full Playlist, and you'll see our discussion of like gap momentum, which was last week. There's our ribbon study discussion. And finally, what we're going to be talking about next is going to be our trend. Let me see if I can find it. There it is. Understanding the trend, value, momentum chart trading system. Let's go back to Thinkorswim and load that up as we shift gears here from existing positions to starting to plan a new trade. All right. So let's go to our S&P 500 chart. We did not use gap momentum to analyze the S&P. Right now, you'll notice there's going to be an oval out here, floating out here in space. What's going on there? Well, let's load up our study set for TVM, the TVM strategy set. So the TVM, if you didn't see that webcast, stands for trend, value, and momentum. So a trader who uses this particular combination of technical indicators might be looking for, first of all, a confirmation of trend, bullish or bearish. And on the S&P 500, as rough as this correction has been, and yes, just this week on a couple of occasions, we dipped down below 10% from these all-time highs. That's what we call a market correction. Not bear market, but a correction. We typically have a correction anywhere from about, on average, every 1 or 2 years. And it had actually been back to October of 2023 since we had our last correction, which went down 11%. We had a near correction right back here, which was 9.7%. But yeah, we've pulled back about 10%, starting to see a little bit of promise for the bulls. We'll see if it continues higher. But how might we look at this through that TVM lens? Well, a trend confirmation would be to see our upward slope, first of all, an upward slope to our longer term or slower triangular moving average. That's what this sort of burgundy colored line is. It's a 100 period triangular moving average, a longer term trend, and then set against that, in contrast to that, is a 50 period triangular moving average, which is shorter term, not truly short term. It still takes into account 50 trading days of data, or about 2.5 months. But a trader here might just be looking for, is there still an upward slope to our longer? And is the shorter still above that long? And it is. It's been kind of teasing at that longer term moving average, but still, shorter trend above the longer trend may indicate, despite these 3 weeks of selling, maybe this is just taking us down to short-term market lows. Obviously, that's a tale yet to be told. We'll see. We'll see where we go from here. But trend, let's just put a check in the box next to bullish through this specific technical lens. Well, let's look down here at our momentum indicator, which is our MACD histogram. Now, not everybody uses a combination of MACD, histogram, RSI, and a pairing of triangular moving averages. But theoretically, what we're looking for here is, if we're in an upward trend, there can be short-term shifts of momentum within that trend as we rise from lows to highs and back down to lows, back and forth. And so for a trader, they might be looking for, are we starting to show signs that we've come down to a low, and the momentum might be shifting from bulls to bears? And a specific indication of that, using MACD histogram, is when we get a bright red histogram bar that shifts to dark red. Now, we've had a few of those. Chop, 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 chop. We've had 4 or 5 of them. I would say that 3 of these 4, and maybe this 4th one as well, might have been seen as not being valid, depending on if a trader uses this specific approach or not. Because here's what we might want to pair this with as a confirmation. That would be looking up to our RSI. Did the RSI line, number 1, get below 40? And you can see that we've been below 40 here. Number 2, did it get back up above 40? And you'll see right here, we actually did get a darker red line on our MACD histogram, indicating maybe momentum's heading higher. And our value indicator came down into value territory and started to rise again. Ooh, the little bit of strengthening. We saw maybe one day where price cooperated, and after that, nope, that was a whipsaw. Now, subsequent to that, we've had 1, 2, 3 would-be signals, potential signals here, but our RSI has still been hovering below 40. So the trader using this approach might just wait until, look at today. We have a 5th darker histogram bar, and we're rising toward that 40. Notice I put a question mark next to this. Do we yet have confirmation? Not quite. However, if we were to take all of this together, let's make a decision. Does this seem to tilt bullish or bearish? Well, if a trader weren't using this sort of an approach, they might just be looking at this selling and just think, oh, this is just rough. Who knows how long this selling is going to go? However, with an approach like this, it might actually tilt the scales the opposite direction. Still have bullish confirmation here. We at least have rising momentum. We just don't quite have that confirmation on our value indicator yet, rising back up above 40. So again, if you want to see that approach being illustrated, you might want to go have a look at that webcast that I just showed you a little bit earlier. It's about 2 months ago that we had this discussion in good detail. So there's the S&P as a backdrop. Yeah, we'll see if we can continue to rally. We'll see. Time will tell. But it was the S&P that caught my eye today, especially when paired with a different technical indicator that some of you might be familiar with. So go ahead and chat in now. Let me know. Have you used advanced decline before? Now, I'm not talking about ADX. I'm talking about specifically advanced decline. Or are you familiar with advanced decline, whether you use it or not? Okay, Edwin says, what ranges are your SMAs? So Edwin, these are not SMAs. These are triangular moving averages. And they are 50 and 100 period. You can see that right up here, 100 indicated right here and 50 right over there. Yep. They actually are pretty similar to like a simple moving average. They're just kind of smoothed out. Okay, Sharon says no. Chris B, yes. Joey, no, 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 no. Looks like a whole bunch of no's. Life in the fast lane, yes. Okay, so this is going to be new to most of you. That's okay. Some technical indicators, I will say, they're fairly complicated. Others, they're fairly straightforward, and I would definitely put this in that latter category. The calculation of it, to me, is fairly straightforward. So let's switch this up. Let's take off our current study set. Let's just remove them all. And let's add this thing known as advanced decline. And I'll talk about what it's supposed to be measuring first. Let's go ahead and type in more of the word advanced. It's just going to limit the number of potential studies here to those including the word advanced. So specifically what we're looking for is just called advance decline. Advance decline. Guess what? Just the title kind of gives away what this does. But let's just add that to our chart. And as we go to do this, I'm going to point out something here. NYSE. That's important. Okay? But let me just apply this to our chart of the S&P 500, and I'm going to switch up our chart for just a moment. I'm going to bring up the index for the NYSE composite. All right? So we're going to start off sort of comparing apples to apples, and then we're going to look at kind of a maybe this one is maybe this one's a Granny Smith, and then we're going to look at a Fuji or something. It's still going to be apples to apples. All right, but our advanced decline line down here is really attempting to address that question for some traders when they see the markets are selling, or let's put that in air quotes, the markets are selling and the markets are buying. Well, when markets are going down, does that mean that every stock in the market is also going down? Is it possible that we could say the markets are going down when actually most stocks are going up? Yes, it depends on which index one is using. But since many indices are what we call cap weighted, or in other words, the big companies really drive which way the index go. They carry a disproportionate amount of weight in which way an index goes. It's quite possible that there can be conditions where maybe the big companies are taking a beating, but a lot of the smaller ones are still prospering, and yet we would say the markets are going down because the big companies are the ones that we're paying attention to. Or just the opposite could happen. It might look like, oh, everything's roses, the markets are going up, and yet we go look at our portfolios, and our portfolios might be struggling, because if our portfolios are weighted differently than the indices that we're watching are weighted, if our portfolios tilt small capitalization, whereas the indices might tilt large capitalization, we might not be getting the right impression of how our portfolios are likely to be performing. So it's a natural question to wonder, hey, during this sell-off or during this advance, during this decline, or this advance decline, how widespread is the buying, or how widespread is the selling? That's what this is doing. And basically, if we see this line going up, what that means is that most of the companies of the NYSE, those listed on the NYSE, are advancing. If this is going down, most are declining. So let's talk about how it's calculated. It's really not a difficult calculation. Yeah, let's go ahead and type it out. I wasn't going to type it out. I'm going to type it out. So let's make this bold. Let's type in the word calculation of the AD line, advanced decline line. We basically just take the NYSE advances, those stocks that went up on a given day, and we subtract the NYSE declines, those that went down on a given day, and we generate a value. So let me just say about 1,500 companies in NYSE Let's say that 1,000 went up one day. Doesn't matter whether it was the big ones, the small ones, a mix of which. There's 1,000. Okay? And let's say that the other 500 went down. Well, 1,000 minus 500 gives us an advanced decline value for the day of 500. But then we just add that to the previous day's AD value, and that generates for us this line. So it really is how many advances, how many declines, give us a number, add that to yesterday. If it's a negative number, it gets subtracted from yesterday, and that can cause prices to go down. So it really is a pretty good window into how widespread buying and selling is distributed across the markets. And for some, that can be an important insight. So you might think, well, isn't that just going to do what the in this case the NYA, the NYSE Composite Index does? Nope, because this is a cap-weighted index. This can go one direction while its advanced decline goes another. So here's one thing that some traders might look for. There was an interesting event that happened right here from mid-November to, from mid-October to early November. So what happened up here on our price chart of the NYSE Composite Index? Well, if we're just applying, some basic Dow theory of trends, we might look at this running up to a peak here. I don't want to draw an oval. Let's switch up that drawing tool. Let's remove that drawing. Let's do lines. But we ran up to a peak here in mid-October and then sold off to a low. And then ran up to a subsequent peak there in early November, accomplishing higher highs. So for an index tracker, they might look at this as confirmation of bullishness on the index, and they might, let's say, go more aggressively position toward bullishness in their portfolio conceptually. Now, Ricebird says there is a red color scheme to our advanced decline line. It doesn't mean anything other than it went up one day or down the next. Yep, good question. There's your answer. But someone looking just at a price chart of NYSE might conclude higher highs, looks bullish. However, if we peel back the layers and we look at just a comparison of the number of advances versus the number of declines, actually, we saw a lower high here. And here, we're going to have to split some hairs. I'm going to have to zoom in on this because it's kind of hard to see. So the one thing that I want to call your attention to is this number in red or green, as we're getting an uptick or a downtick there on our AD line, Ricebird. Yep. Just follow this as it goes higher. And you'll notice we hit a peak right here. I think that was October 16th. We got up to a total value of 24,939. Do you see that there? And at the same time, that's about where we were peaking on our index. Now, we had some selling on the index, and our advanced decline line came down. And then we started to advance again. And let's do a numerical comparison here. 24,939 versus at this peak, 24,827. That's a 100-point net decrease from peak to peak. So what does that mean? Well, that might that literally might translate to there just wasn't as wide a difference between the number of stocks advancing versus the number of stocks declining during this particular advance. On the chart, it just looks like a bunch of white candles taking us to a higher high. But behind the scenes, it's not as widespread distribution of the fun here for the bulls. And Chris calls this a divergence. You're exactly right, Chris. Yep. We say that our index is diverging in its behavior from our price index. I should say our indicator is diverging in its behavior from our index. So whereas we got higher highs on the index, we have lower highs on our indicator. And what might that imply? Wow, okay, we got another advance. It even took the index higher, but not as many companies got to participate in that advance. Maybe that's an indication of weakness that's not otherwise apparent. Now, you'll notice, did it result in an immediate sell-off? No, actually, we did get a little bit higher on the index, but really since that day, if I right-click on that second high and I extend that to the right, you can see how few days the NYA has enjoyed above that level. It's really struggled since that, that divergence event. Okay, well, that's not fun. Should we talk about something a little bit maybe more fun? What's happened more recently? And I want to switch this over to the S&P 500 for this part of the discussion. Let's look at the S&P 500. We see, we're still looking at, by the way, still looking at the NYSE advanced decline. Now, we could change the index that we're pulling from if we wanted to. We could switch this from the NYSE maybe to the NASDAQ, maybe the Amex or NYSE American. But for most traders, they'll leave this at its NYSE default to get a gauge of how widespread this distribution of buying or selling is. So our indicator down here has not changed. It's still the same indicator. But we're looking at a different index. And let's look at this back in October and November. Was the S&P kind of moving with the NYA, making higher highs at that time? Yep, saw higher highs here. Match that against the lower lows on our breadth indicator, the breadth of or depth of distribution of buying and selling. Yeah, still saw higher high here, still saw lower low there, still struggled from that point. Let me just right click on this. Let's remove this and draw a line right from there. You can see we got a little bit higher on the S&P, but not much. Pardon me. So again, I said that wasn't fun, but what's happening more recently on that advanced decline? The S&P sold off starting here back in December. We got off to kind of a weak start for 2025, went down to a low here. So high here to a low there, and then started to rise. So we established a low, ran up to a peak. We've now sold off to a much lower low. This looks just terrible. And yet, what has been the ratio of participation of declines to advances? Well, even with this big sell-off, our advanced decline line hasn't come down as far. So the interpretation there might be the selling may not be as widespread. Maybe there are some positions there finding strength. So we have now what we call a bullish divergence on our indicator. Now, if we really wanted to get fancy, should we do this? Let's do this. Let's come up here to our studies. Let's load up our TVM strategy set and go ahead and throw on that advanced decline as well. And so a trader here might be looking at trend still looks good. The value appears to be there. Momentum starting to rise. And we have a shallower breadth to the selling that we've been seeing recently. We have bullishness down here as well. Now, if we add these up, does that guarantee that we're going to see an advance in the S&P 500 from here? Nope. Are we off to a nice start today, up about 2%? Yeah, that's kind of nice. It'd be nice, we still have a lot of distance to climb to get back up to these all-time highs. But let's just say that our trader thinks, hey, the preponderance of this technical evidence points toward an upside bias to the markets. And so maybe now let's go place a trade. Let's go look for a stock out there that might be showing similar bullishness. So I'm now going to remove the advanced decline line, typically used in combination with an index to make decisions regarding potential market highs and potential market lows, and also maybe just confirmation of market trend. If the indicator is going in the same direction, generally making higher highs and higher lows, if our index is going up at the same time, that's just confirmation. If they're going down together, it's just confirmation. It's the divergences that can really catch the eye sometimes. So some of your chatting in symbols, I already have one prepared. But let's come up here. I'm going to edit our studies and take off the advanced decline line. It's not typically used with an individual security. So the one that I wanted to have a look at was Netflix. What's going on with Netflix? Yeah, okay, Chris has a lot to maybe look at, but here's what's happened with Netflix. Recently rose up to a high, broke a pretty prominent previous high that acted as a support here. Where did that take us, though? Overall, it looks like a trader might still see this as an intact bullish trend, at least if they're looking at this through the lens of that triangular moving average pairing. So price is trading right at our 100 period triangular moving average. The 50 period triangular moving average is still rising above the 100. The 100 itself is still rising, so some technical evidence there for bullishness. As we look down at our RSI, we accomplished something that doesn't happen very often, and that is for our RSI to dip down below 40. You can see with Netflix, it's only dipped down below 40 on 3 other occasions this year, and did a pretty good job. That did a pretty good job of signaling when these bearish pullbacks turned into sort of bullish reversals. There was another near miss right there that wasn't a bad signal itself. But we've gotten down below 40, starting to rise again. So trend, T, looking potentially bullish. Value, V, looking potentially bullish. And what about our momentum, our MACD histogram? It has dipped down below 0. Notice it got some reversals here, but we were still above 40 at that point here. We were also significantly above our trend line up here. But we're starting to see that momentum rise. I think what we'll do today, let's add this to our study set. So I'm going to save this. Let's save this as our Netflix TVM strategy set. There we go. So we know we took our trade here on Netflix. Let's draw an oval around our entry date right there so that we remember what we did next time. And let's go buy some shares. Now, this is a fairly expensive stock. It's a $900 stock. We typically only spend about $5,000 on a trade. That would be around 5, maybe 6 shares. I'm going to squeeze that up to 6 shares. So let me go to my trade tab. Here's Netflix. Let's click on the ask price. Now with this, the trader, if we're planning an exit, it may just be if we break down below recent lows. So how about for this one? Let's look at this recent low. That's pretty close. We're not giving this a lot of wiggle room. So maybe if we had a tendency to go 1% below that low, maybe expand that out to 2 or 3 if we feel like we need to give that a little bit more grace before it gets whipped out. What was that low on that day? That was 854.50. How about if we go a couple of percentage points below that? Get out our calculator. 854.50 times 0.98 has the effect of subtracting 2%. 837.41 is going to be our stop on this trade. So let's go buy some shares and put a stop on there. Let me open that up so we can see. I want my calculator to be visible because I didn't memorize that number. Let's right click on our ask price and put in a custom buy order with a stop for, now I got to hide this, 9 shares. I don't want to go down by my full increment. Let's set this for 9 shares. Not 9 shares, 6 shares, right? 6 shares. And 6 shares here. There we go. And with the markets open, I'm actually going to submit this as a market order. Obviously, there are risks. If we submit market orders, we're just saying, hey, I'm willing to pay whatever the market requires in order to get these shares. So we might not be thrilled with our fill. It says about $912 right now, but that's not guaranteed. And let's put our stop down there at 837.41. Here we go, 837.41. And we want to make sure that that stop order is good till canceled. If we don't do that, this sell order would just expire at the end of the trading session, at the end of the trading day. So we're ready to place our trade. Let's click confirm and send. Buying 6 shares of Netflix at the market. There's a reminder right down here with market orders. Prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. We've already crept up a few pennies. We might have to pay a few pennies more. We'll see. We also have a stop in to sell those shares at 837.41. But with stop orders, there's no guarantee that the execution price, the amount we receive, will be equal to or even near the activation price. And in this case, the activation price being 837.41. A big gap down may cause us to sell at a significantly lower price than that 837.41. There's no commission on this trade, but there can be on certain types of trades. And let's send this off. And let's see, we're in. Oh, yeah, look at that. It moved on us quite a bit. I told you, this thing's moving. It went up another $1. It's actually even beyond that right now. So 912.84, is that what we filled for? Great. All right, well, we're in for that trade, and we have done what we set out to do today. When we kicked off this discussion, I did want to review current positions. We only had a couple, so we had to look at what's going on with those, one of which really should have been over by now. We also had to look at the S&P 500 through our TVM lens, but then we also looked at it through the advanced decline line. Sounds like that was a new indicator to a lot of you, and that's good. I want to help us understand the tools that are available on Thinkorswim so a trader can fill up their toolbox with whatever tools they see are appropriate for their approach to trading, if they're using technical trading tools at all. These webcasts are always just intended to be educational. It's never a promotion of a specific approach to trading. Always bear that in mind, okay? And we even went in, placed a new example trade using the AD line as a backdrop on the index. We went out and placed a new bullish trade on Netflix. We'll see if that pans out in future webcasts. Make sure that you're joining me in those future webcasts so you can see these trades as they evolve. But everybody, go enjoy the rest of the webcasts that we have for you through the rest of your Friday afternoon. Ben, thanks for helping out in the chats. That's very much appreciated. But before you go, everybody, just remember, first of all, if you're not subscribed to our Trader Talks channel on YouTube, make sure you track us down here. This is where you'll find our playlist for our previous webcasts, and you can join the live streams here as well. But you can subscribe just by going down below the video stream and clicking on that subscribe button right now. It takes 1 second, and it doesn't cost anything, but then you're subscribed to the channel. Also, make sure that you're following Ben and me on X. Best place to find us in between these live streams. So my handle on X is at Cameron May CS. You can find Ben on X at Ben Watson CS. But this is where you can connect with me in between the live streams. You can also see what Ben and I have to say about markets or market observations. I don't know if you noticed this. Yeah, $3,000 an ounce for gold for the first time ever. So I just called that out. But everybody, thanks for giving me your time today. Thank you for all of the likes. 150 people watching. 58 people have already clicked that thumbs up button. That's very much appreciated. I will see you in a future webcast, everybody. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.